Okay, let's just dive right in. Healthcare costs.
Right.
It's a constant, isn't it? Especially if you're running a business. You get those group health insurance premium notices every year. And, well, one of the sources we looked at, it's projecting something like a 9.2% jump in 2025. And that's before you even think about changing the plan.
Yeah, it's a huge pressure point. Feels relentless sometimes.
It really does. Like you're just treading water trying to keep up.
Yeah.
And then for employees, even with insurance, you've got deductibles, co-pays, all those out-of-pocket costs. They can feel like this unpredictable hit to your wallet.
That's right. It creates a lot of financial anxiety for people. The traditional ways just feel increasingly rigid and expensive. So folks are definitely looking around for smarter alternatives.
Exactly. What if there was a different way? Something that gives employers, a bit more control over the budget, but also gives employees some real flexibility, some actual financial help.
And that's where these health reimbursement arrangements, or HRAs, come into the picture. They're gaining a lot of traction.
Which is precisely what we're getting into today. We've gathered a whole stack of materials, guides, articles, some really interesting case studies to really try and unpack what HRAs are all about.
Yeah, our goal here for you listening is to cut through the jargon and give you the core information. What are they? How do they actually work? Why are they becoming such a big deal right now? What are the different flavors they come in?
And maybe some things to watch out for, too. The idea is to get you informed fast so you can figure out if maybe, just maybe, an HRA could be relevant for you, whether you're an employee or running a business.
Think of it as your quick guide to a potentially really useful tool in that whole health benefits puzzle.
All right, so let's start at square one. What exactly is an HRA, like fundamentally?
Okay, so at its most basic level, an HRA is an employer-funded health benefit plan. That's the key word, plan. It's set up by the company, and the purpose is to reimburse employees for eligible medical expenses. And sometimes, depending on the specific type, it can even cover health insurance premiums.
Okay, plan, not account. You emphasize plan, and the sources seem to do that too. Why is that distinction so important?
It's really crucial because it helps clarify what's happening with the money. It's not like there's a separate bank account for each employee with a pile of cash sitting there from day one.
Okay.
Some sources call it an unfunded notional account, which sounds a bit technical, but it basically means it's more like a promise, a framework for reimbursement. The employer decides how much allowance you could get.
Right.
But they generally only pay out the money after you've actually incurred an expense and submitted a valid claim. They pay from the company's general funds at that point.
Got it. So the commitment is there, the allowance is set, but the actual cash flow happens only when a claim is approved. Makes sense.
Yeah.
And who puts the money in? Is it like a 401k where both can contribute?
Nope. And this is probably the single most defining feature, stressed again and again in everything we read. HRAs are 100% employer funded, solely. Wow. Employees are not allowed to contribute their own money. That's a massive difference compared to, say, a health savings account, HSA, or a flexible spending account, FSA, where you often see employee contributions through payroll deductions. With an HRA, it's all on the employer.
Employer funds it completely. Simple. So what's the big picture goal then? Why are employers bothering to set these up?
Well, the main objective is pretty straightforward. Help employees pay for their health care, make it more manageable. And by doing that, the employer is providing a valuable benefit, but one that also gives them some advantages.
Like controlling those costs we talked about.
Exactly. It helps employees with their financial burden, but the structure itself offers the employer better cost control and some significant tax benefits, too. It's designed to be a bit of a win-win, ideally.
Okay, tackling costs head on. Let's dig into the mechanics then. You said it's a reimbursement model. Can you walk us through the actual steps? Like if I'm an employee with an HRA, what happens day to day?
Sure. So forget the idea of swiping a card at the pharmacy and having funds deducted instantly, usually. The standard process starts with the employer setting an allowance amount.
Like you get $200 a month or maybe $2,400 for the whole year.
Precisely. That's the maximum the employer is committing to reimburse you for during that period. Then you just go about your life. You go to the doctor, you get a prescription filled, maybe see the dentist. You incur an eligible medical expense.
And I pay for it first, with my own money.
Typically, yes. You pay that $30 copay or maybe that $150 bill for new glasses using your own cash, check, or credit card. That's the standard way.
Okay, so payment comes first. Then what?
Then comes the claim. You need to ask your employer, or usually their administrator, for reimbursement. And this is the critical part. Documentation. You absolutely need proof.
Like receipts?
Receipts, yes, or itemized statements from the provider. The sources are clear on this. The documentation needs to show the date you received the service, what the service was, how much it cost, and who provided it. It's basically like submitting an expense report for work travel, but for healthcare.
So hang on to that paperwork, digital or physical. Super important.
Absolutely vital. Without it, the claim won't get approved. So you submit the claim and your proof. The employer, or more often these days, a third-party administrator reviews it.
What are they checking for?
Two main things, really. First, is this actually an eligible expense according to the specific rules of this particular HRA plan and, the general IRS guidelines? And second, is the documentation sufficient? Does it prove you paid for that eligible service?
And if it all looks good, approved.
Then you get your money back. The employer or administrator reimburses you for the approved amount up to whatever allowance you have left for that period. Usually it's through direct deposit into your bank account that's fastest, but sometimes it might be a physical check.
Okay, that makes sense. Pay, claim with proof, get reimbursed. But I thought I saw something about making it easier, like maybe not having to pay out of pocket first. What about those HRA debit cards?
Ah, yes. That's definitely an option some HRA administrators offer. They can issue a special debit card that's linked directly to your HRA allowance.
So you could use that card right at the doctor's office or pharmacy.
Exactly. You can pay for eligible expenses directly at the point of service. It feels a lot more convenient, more like using a traditional health insurance card, and avoids that lag between paying and getting reimbursed.
That sounds like a big improvement for the employee experience.
It really can be. Now, there's another potential convenience feature too, sometimes called medical crossover or automatic payment. This usually happens if the HRA is tightly integrated with the employer's main health insurance plan.
How does that work?
Well, once you use your main insurance and they process the claim, the system can automatically figure out what you still owe your deductible, copay, etc. And if it's an eligible HRA expense, it can sometimes trigger the HRA reimbursement automatically, or at least pre-populate the claim for you.
Oh, wow. That sounds even slicker. Less admin for me.
It can be, but there's a potential wrinkle, a nuance mentioned in the sources.
Okay.
That automatic crossover might not be ideal if you have other health insurance, like secondary coverage through a spouse's plan or maybe Medicare.
Why not?
Because normally you'd want your secondary insurance to process the claim first to see what they cover before you tap into your HRA for any remaining balance. If the HRA pays out automatically based only on the primary insurance, you might use up your HRA allowance on something the secondary plan would have covered.
Right. You need to coordinate the order of payment. So you might need to turn that automatic feature off in that specific case.
Exactly. You'd need to manage that coordination manually to make sure you're maximizing all your coverage before dipping into the HRA. So it's convenient, but with a caveat for people with multiple coverages.
Okay, good to know. So the basic flow is pay, claim, reimburse, but with options like debit cards and potential auto payments to streamline things. Now let's step back again. You mentioned the employer only pays out upon reimbursement. Why is that structure, paying after the fact, such a big deal for the employer compared to just, giving everyone a raise to cover health costs?
That design is really at the heart of why HRAs are attractive for employers focused on cost control. Think about traditional group health insurance. The employer pays a fixed premium, say $500, for every enrolled employee every single month. Doesn't matter if that employee uses $50 worth of care or $5,000 that month, the employer pays the $500 premium regardless.
Right. It's a fixed cost based on enrollment, not actual usage.
Precisely. With an HRA, the employer's payment is conditional. They set that maximum allowance, say $200 a month, but they only actually spend money when an employee submits an approved claim. If an employee only claims $50 in a month, the employer only pays out $50. If they claim nothing, the employer pays nothing for that employee that month related to the HRA.
So their maximum possible cost is capped by the allowance they set.
Exactly.
But their actual spending could be lower if employees don't use the full amount.
Yes. It introduces this element of paying for actual claimed usage up to a predictable limit, instead of paying for potential usage through fixed premiums. This significantly lowers the employer's financial risk compared to facing those unpredictable, often massive premium hikes year after year.
That's a really powerful difference in managing budgets. It shifts the risk profile.
It absolutely does. It puts a level of predictability and control back into the employer's hands.
Which leads us perfectly into the bigger question, why now? What's really driving this increased interest in HRAs from both sides, employers and employees?
It really boils down to navigating the pressures of the current healthcare system. Like we said at the start, costs are climbing relentlessly. Businesses, especially smaller ones, are desperately seeking sustainable ways to offer good benefits without breaking the bank.
And employees want flexibility, right? They want benefits that actually help them afford care when they need it.
Exactly. People want choices, and they want real help with those out-of-pocket costs. HRAs seem to offer a potential answer to several of these pressures.
Okay, let's break down those benefits, focusing on the employer side first. We've talked about the payment model reducing risk. What else is driving employer adoption?
Well, the biggest one is probably getting off that traditional group insurance premium escalator. Remember that 9.2% projected hike? That's the kind of financial volatility employers are trying to escape.
So by using an HRA, especially certain types, they can kind of sidestep that.
Yes, particularly with HRA types that reimburse employees for buying their own individual insurance. The employer moves from paying a variable premium dictated by the insurance market to offering a defined contribution that's set HRA allowance.
Meaning they decide how much their costs go up each year.
Pretty much. They control the increase. If they decide to raise the HRA allowance by 3% next year, their maximum cost exposure goes up by 3%, not by whatever the insurance carrier decides the market needs, which could be 10%, 15%, who knows. It brings massive budget predictability.
That sounds huge for planning. Knowing your maximum health benefit spend for the year ahead.
It's critical, especially for smaller businesses where cash flow is tight. Stable forecasting becomes possible.
What about taxes? Is there an advantage there for the employer?
Oh, definitely. This is a major plus. The money an employer contributes towards an HRA, the reimbursements they pay out is generally 100% tax deductible for the business as a regular business expense. So it's a very tax-efficient way to provide compensation in the form of benefits. Much more efficient than just giving employees higher wages to buy insurance themselves, because those wages would be subject to payroll taxes for the employer and the employee.
Right, so it's tax deductible going out for the employer, and we'll get to the employee side later, but generally tax-free coming in for them.
Double advantage. You also mentioned customization earlier. How do HRAs allow for tailoring benefits? Isn't group insurance usually one size fits all?
That's often the case with traditional group plans, yes. Maybe a couple of options, but largely standardized. Certain HRA types, however, specifically the ICHRA we'll discuss later, allow employers to set different allowance amounts for different groups or classes of employees.
Like what kind of classes?
Things like full-time versus part-time staff, salaried versus hourly. Employees working in different geographic locations, maybe based on collective bargaining agreements. There are up to 11 defined classes they can use. So a company with offices in, say, New York City and rural Iowa could offer a higher HRA allowance to the NYC employees to reflect the higher cost of insurance there.
Exactly. They can tailor the benefit to be competitive and fair based on local conditions or job roles, rather than being forced to overspend in one area to adequately cover another, or vice versa. It allows for much more targeted and efficient spending.
That makes a lot of sense for companies with diverse workforces. What about attracting and keeping people? Is that part of the appeal?
Absolutely, especially for small and medium-sized businesses that often struggle to compete with the richer benefit packages offered by large corporations. An HRA allows them to offer a meaningful, flexible health benefit that employees value, but in a way that's financially controllable and less administratively burdensome than managing a complex group plan.
So it becomes a tool for recruitment and retention.
Definitely. It shows they're investing in their employees' well-being in a modern, flexible way. And we already touched on the lower risk because they only pay when claims are made, so you add it all up.
Predictable costs, tax deductions, tailored benefits, help with talent attraction and retention, lower risk. Yeah, that's a pretty compelling list for an employer struggling with healthcare costs.
It really hits on some of the biggest pain points they face with traditional benefits.
Okay, let's flip the coin. What's in it for the employees? Why would I, as an employee, be excited about an HRA?
I think the number one thing, especially with the types that work with individual insurance, is choice. Real meaningful choice. Instead of being shoehorned into the one or two group plans the employer picked.
Which might not have my doctor or might have a huge deductible.
Exactly. With an ICHRA or QSCHRA, you get an allowance and you go to the health insurance marketplace or a broker and you pick the individual plan that works best for you. Your doctors, your prescription needs, your family situation, your budget. That personalization is incredibly powerful.
So I get control back over my actual insurance plan. That's big. What else?
Well, beyond just choosing the plan, the HRA money directly helps with affordability. It reimburses you for those painful out-of-pocket costs. The deductibles, the copays, the coinsurance that can make using your insurance feel expensive.
Right. It helps cover the gaps that the insurance doesn't pay and the money I get back. You mentioned the tax aspect.
Yes, and this is key for the employee. Reimbursements received from an HRA for qualified medical expenses are generally not considered taxable income.
So if I get $100 reimbursed, it's a full $100 in my pocket, not $100 minus income tax.
Correct. It's tax-free money going towards your healthcare costs, which effectively increases your purchasing power or your take-home pay compared to getting that same $100 as taxable salary.
It is a significant benefit, tax-free help.
It really is. And, HRAs can be particularly useful for people enrolled in high-deductible health plans, HDHPs. An integrated HRA, for example, can be set up to specifically cover those initial out-of-pocket costs before the main HDHP deductible is met.
Making those potentially scary high deductibles feel less daunting.
Exactly. It can bridge that gap and prevent people from delaying needed care just because they can't afford the upfront deductible cost. And the flexibility is real. We saw sources mention that during the pandemic, things like at-home COVID tests and even masks became eligible expenses under many HRAs, showing how they can adapt.
That adaptability is neat.
Yeah.
Now, what if I'm lucky and don't have many medical expenses in a year? What happens to the leftover money in my HRA allowance? Is it like some FSAs where if you don't use it, you lose it?
Good question. This varies depending on how the employer designs the specific HRA plan, but unlike the traditional FSA use it or lose it rule, many HRAs do allow unused funds to roll over from one plan year to the next.
Oh, really? So I could potentially save up my allowance.
Yes. If your employer sets it up that way, you could accumulate funds over time to cover potentially larger medical expenses down the road, maybe orthodontics for your kid or a planned surgery.
That adds a savings element.
It does. And we even saw that one really creative example in the sources, that nonprofit.
Right, the one linking it to retirement.
Yeah. They set up their QSE HRA so that employees had the option at the end of the year to take any rolled over, unused HRA funds and actually contribute them to their retirement savings account.
Wow. That's thinking very long term, using a health benefit to boost retirement savings.
It's definitely innovative and probably depends on specific plan rules and compliance, but it shows the potential flexibility. It can position the HRA not just as help for today's bills, but as part of a longer-term financial wellness strategy for employees.
Okay, so for employees, the big draws are choosing their own insurance, potentially, getting real help with out-of-pocket costs, receiving that help tax-free, and the possibility of rolling over unused funds, maybe even linking them to other financial goals.
Yeah.
That's pretty appealing.
It addresses both the immediate pain points of healthcare costs and offers some potential for future planning.
It's clear these HRAs have a lot going for them. But you mentioned earlier, it's not just one thing called HRA. It's more like an umbrella term, right? There are different types.
Exactly. And understanding the different types is absolutely crucial because they're designed for different employer situations, different sizes, whether they offer group insurance or not. Choosing the right type is key.
Okay, let's break them down. What's the first major type we should know about?
Let's start with the Qualified Small Employer HRA, often just called QSEHRA, pronounced QSERA by some. This was sort of the original modern HRA aimed at a specific group.
And who is that specific group?
As the name implies, it's for small employers. The official rule is fewer than 50 full-time equivalent employees. And there's a big condition. To offer a QCHRA, the employer cannot also offer a traditional group health plan. It has to be one or the other for that employer.
Okay, so small business, no group plan. What can employees use the QSEHRA money for?
It's pretty flexible for those who qualify. Employees can use their QCHRA allowance to get reimbursed for their individual health insurance premiums, the plan they buy themselves on the marketplace, for instance, and for other qualified out-of-pocket medical expenses like copays, deductibles, prescriptions, dental, vision, etc.
Is there a cap on how much the employer can offer through a QHER?
Yes, this is one type that has annual contribution limits set by the IRS. These limits get adjusted for inflation. The sources gave us some numbers. For 2023, the max was $5,850 for an individual and $11,800 for a family. For 2024, it bumped up slightly to $6,150 for individuals and $12,450 for families. Employers can offer any amount up to those limits.
Can they give different amounts to different employees, like more for families?
Yes. Within those overall IRS limits, the main way they can customize is by offering different allowance amounts based on whether the employee has self-only coverage versus family coverage. Generally, all eligible employees have to be offered the QSEHRA on the same terms otherwise.
Okay, so QCRA recap. Small employer, 50 fees, no group plan alongside it, covers individual premiums and ID expenses, has IRS annual limits, and can vary allowance by individual versus family status. Got it. What's next?
Next up is the Individual Coverage HRA, or ICHRA, pronounced ICHRA. This one's a bit newer, rolled out more broadly around 2020, and it really opened things up.
How so? Who is the ICHRA for?
This is a major difference from the QHRAs. ICHRAs can be offered by employers of any size. Doesn't matter if you have 5 employees, 500, or 5,000. Any size employer can potentially use an ICHRA.
Okay, so size isn't a barrier. What does it cover?
Similar to the QHRA, the ICHRA is designed to reimburse employees for premiums for individual health insurance policies they buy themselves, as well as other qualified medical expenses.
Is there a catch? A requirement for the employee?
Yes, a very important one. To use the ICHRA funds, the employee and their dependents, if covered, must be enrolled in qualifying individual health insurance coverage, or Medicare Parts A and B, or Part C. They can't typically use it if they're, say, covered only by a spouse's group plan or have no insurance. They have to attest to having this coverage.
Okay, so individual coverage is mandatory for the employee. What about contribution limits? Does the IRS cap ICHRA amounts like they do for QSATRA?
No, and this is another huge point of flexibility. There are no federal limits on the amount an employer can choose to offer through an ICHRA allowance. The employer decides the amount. It could be $100 a month, $1,000 a month, whatever fits their budget and strategy.
Wow, no upper limit from the IRS. That offers a lot more design freedom.
And you mentioned earlier that ICHRAs are really flexible with employee classes.
Extremely flexible. This is where the ICHRA really shines for tailoring benefits. Employers can offer different allowance amounts, completely different amounts, based on up to 11 distinct employee classes.
11, like what?
Things we mentioned before: full-time versus part-time, salaried versus non-salaried, employees in different geographic locations based on rating area, seasonal employees, employees covered by a collective bargaining agreement, even employees in different staffing firm arrangements. It allows for really granular customization.
That geographic one seems particularly powerful for companies spread across the country, like that KEI case study you mentioned. Absolutely. It lets them offer a benefit amount that actually makes sense in the local insurance market for each group of employees, rather than a single amount that might be too low in one place and unnecessarily high in another.
Okay, ICHRA recap. Any size employer covers individual premiums and expenses. Employee must have individual coverage or Medicare, no IRS contribution limits, and highly customizable allowances based on up to 11 employee classes. Seems very versatile. What's the third main type?
The third one is the Group Coverage HRA, or GCHRA. You'll also often hear this called an integrated HRA.
Group coverage. Integrated. So this one works with a group health plan.
Exactly. This type is specifically designed for employers who already offer a traditional group health insurance plan. The GCHRA integrated HRA doesn't replace the group plan. It works alongside it, integrated with it.
So it's not about helping employees buy their own insurance like the QHRA or ICHRA.
Correct. Its purpose is to supplement the employer's group plan. It reimburses employees for qualified medical expenses that are not fully paid for by that main group health insurance.
Meaning deductibles, co-pays, co-insurance, things you pay when you actually use the group plan.
Precisely those things. It helps employees cover their share of the costs incurred under the group plan.
Can employees use the GCHRA money to pay their monthly premium contribution for that group plan, like the part that comes out of their paycheck?
No, that's a critical restriction highlighted in the sources. An integrated HRA cannot be used to reimburse employees for the premiums of the group health plan it's integrated with. It's strictly for those out-of-pocket costs, like deductibles and co-pays that arise from using the plan.
Got it. No premium reimbursement for the main plan. Are there contribution limits or class customization options here?
Similar to the ICHRA, there are no IRS set limits on the contribution amount for a GCHRA. The employer determines the allowance. And yes, employers can offer different allowance amounts to different classes of employees, similar to the ICHRA structure, although maybe less common in practice since everyone is on the same underlying group plan structure.
Okay, GCHRA integrated HRA. For employers with a group plan, supplements that plan by covering out-of-pocket costs, not premiums, no IRS limits, can be customized by class. All right, one main type left.
The last of the big four is the Accepted Benefit HRA, or EBHRA.
Accepted benefit. What does that mean? What kind of benefits are accepted?
Think of benefits that are generally considered separate from your main comprehensive medical insurance. The EBHRA is offered by employers who also offer a traditional group health plan, though employees don't necessarily have to be enrolled in that main plan to get the EBHRA. It's designed specifically to reimburse costs for certain accepted benefits.
Like what?
The main ones are things like dental insurance premiums, vision insurance premiums, short-term limited duration insurance premiums, maybe COBRA continuation coverage premiums. It can also sometimes cover cost sharing like copays or deductibles for these types of accepted benefits.
It was really targeted at those supplemental things, teeth, eyes, maybe short-term coverage gaps.
Yes, exactly. It's a way for employers to offer help with those specific costs. A key feature is its flexibility. An employer can offer an EBHRA even to employees who decline the main group health plan offer. However, just like the GCHRA, it cannot be used to reimburse premiums for comprehensive individual or group health insurance, only for those specific accepted benefit premiums or costs.
Is the EBHRA subject to contribution limits?
Yes, this one does have annual contribution limits set by the IRS, similar to the Q2HRA. The sources didn't detail the exact limits for recent years, but they confirmed that federal caps do apply to the EBHRA.
All right, EBHRA recap. For employers offering a group plan, but employee enrollment isn't required for EBHRA, covers specific accepted benefits like dental vision premiums or short-term insurance premiums, not comprehensive premiums, has IRS annual limits. Wow, that's four quite distinct types under one acronym.
It is. And, the sources briefly mention even more specialized types, like retiree HRAs just for former employees, or very limited purpose HRAs that might only cover dental and vision, which sometimes have specific rules allowing them to be paired with health savings accounts, HSAs. But those four, QCHRI, ICHRA, GCHRI, and EBHRA, are really the main ones most businesses and employees will encounter.
It definitely seems like there's an HRA flavor designed for almost any employer situation, small, large, with a group plan, without one.
The variety really reflects the different ways employers want or need to structure their health benefits offerings today.
Okay, understanding the types is one thing, but seeing them in action really makes it click. The sources had some great case studies. Let's bring these to life a bit.
Absolutely. Those real-world examples show the impact much better than just definitions.
Tell me about that small business, the one that ditched the expensive group plan. What happened there?
Yeah, that was a perfect QSRA scenario. A small company, under 50 employees, was just getting hammered by their group health insurance premiums, paying around $500 per employee each month. It was costly, and employees weren't thrilled with the limited plan choices anyway.
So they switched.
They switched to a QSRA. They decided to scrap the group plan entirely and instead offer employees a $300 monthly HRA allowance.
So, boom, right off the bat, their fixed cost dropped by $200 per employee per month. That's $2,400 a year per employee saved for the company.
Huge direct savings for the business, exactly. But it wasn't just about the company saving money. The employees now took that $300 tax-free allowance and could shop on the individual market for a plan they actually wanted, one that fit their needs, their network, their budget.
So more choice for them and probably better satisfaction.
That's what the case study indicated, improved employee satisfaction because they had control. And the company got predictable, lower costs. It was a win-win, really hitting that core QSRA value proposition.
Great example. Now, what about that more unusual one? Using an HRA to incentivize performance. That sounded interesting.
That was Hotel Pommier. They used an ICHRA, but they got really creative. They didn't just use the allowance for standard medical reimbursements. They actually tied additional HRA allowance amounts to certain employee goals, specifically good attendance records.
Wait, so if you showed up consistently, you got more money in your HRA?
Essentially, yes. They used it as a tangible reward for meeting attendance targets. It turned the health benefit into a tool to actively encourage desired behaviors, like reducing absenteeism, which is a big deal in the hospitality industry.
That's really thinking differently about benefits, linking health dollars to productivity goals.
It really is. The case study suggested it helped them reduce absenteeism, improve staff reliability, and boost morale. It just shows how the flexibility of the ICHRA, the lack of federal contribution limits, and the ability to define eligible expenses within reason can be leveraged for broader business objectives, not just healthcare cost reimbursement.
Very smart. Okay, and then there was the larger company, the ones struggling with employees in different states.
Right, the KEI example. A franchise operator with 200, 350 employees spread across California, Arizona, and Missouri. The problem was that a single group health plan just didn't work well across those very different state insurance markets.
Because costs and networks vary so much.
Dramatically. So a plan that was adequate or affordable in Missouri might be terrible or way too expensive in California, and vice versa. This led to low participation in the group plan and unhappy employees. They switched to an ICHRA.
And how did the ICHRA fix that multi-state headache?
Because the ICHRA allows employees to buy their own individual plans using the allowance. So employees in California could pick a California plan suited to that market. Employees in Arizona could pick an Arizona plan. The ICHRA's ability to set different allowance amounts by geographic location was key here too. They could offer an amount that made sense for each state's cost structure.
What was the result for KEI?
The case study reported a really significant outcome. About a 30% reduction in their overall healthcare spending compared to the old, inefficient group plan. They got predictable costs through the defined contributions, employees were happier with relevant local plan choices, and apparently, the administration became easier using an ICHRA platform.
A 30% saving for a multi-state company is massive. Clearly shows the power of that geographic customization in the ICHRA. And lastly, that nonprofit linking HRA funds to retirement. How did that work again?
That was Big Brothers Big Sisters of McHenry County, using a QSE dose. They included a rollover feature, which is fairly common, allowing unused funds to carry forward. But they added a unique provision. At year-end, employees had the option to take those accumulated unused HRA dollars and direct them into their retirement savings accounts.
So instead of just saving for future medical bills, it could actually boost their retirement nest egg.
Potentially, yes. Now, this is likely a more complex setup requiring careful plan design and compliance checks. It's not necessarily standard, but it highlights the potential creativity, especially with rollover funds in QSE HRAs. It framed the health benefit as contributing to long-term financial security, not just immediate health needs, which could be a powerful retention tool for a nonprofit.
These examples really paint a picture, don't they? From straightforward cost savings to performance incentives, solving geographic challenges, even enhancing long-term savings, HRAs seem incredibly versatile.
They absolutely can be. They shift from being just a passive benefit category to potentially being an active strategic tool for businesses.
Okay, we've covered a ton. The what, how, why, the different types, seen them in action. Before we sort of pull it all together, are there any other important details, maybe some nuances or potential pitfalls that people should really keep in mind?
Definitely a few key considerations. One is understanding exactly what expenses are eligible for reimbursement under any specific HRA.
Isn't it just standard medical stuff?
Generally, yes. HRAs align with the broad definition of qualified medical expenses in IRS Section 213D, things like doctor visits, prescriptions, hospital care, dental, vision, mental health, etc. You can find the full list in IRS Publication 502. However, the employer has the ability to create a more restrictive list in their specific HRA plan document.
Oh, so just because the IRS says something could be eligible, my employer's HRA might not actually cover it.
Precisely. The employer's official plan document is the ultimate authority for their specific HRA. So employees really need to check that document or the summary plan description, SPD, to know for sure what they can get reimbursed for. Don't just assume.
Got it. Always check the plan document. What about portability? We touched on this comparing it to HSAs, but it seems like a really big deal for employees changing jobs.
It is a huge difference and probably one of the main limitations of HRAs from the employee perspective. HRA funds are generally not portable. When you leave your job, whether you quit, retire, or are laid off, any unused money or allowance remaining in your HRA typically stays with the employer.
So unlike my HSA, which is my money and comes with me wherever I go,
Correct.
the HRA balance essentially vanishes when I leave that specific employer.
That's the general rule, yes. The HRA is a benefit tied to that specific employment. That lack of portability is a key thing for employees to understand.
Okay, important distinction.
Yeah.
What about using an HRA alongside other accounts like an HSA or an FSA? Can you have multiple types? Sounds potentially messy.
It can be messy, and the coordination rules are very specific, but yes, it's sometimes possible. For instance, you might have an HSA-compatible high-deductible health plan, HDHP, and your employer might also offer a limited-purpose HRA.
Limited purpose.
Meaning the HRA is restricted to only reimbursing, say, dental and vision expenses. Because those typically don't affect your HDHP deductible status, that combination can work. Or sometimes an integrated HRA paired with an HDHP might be designed so it only starts reimbursing after you've personally met the minimum statutory deductible for HSA eligibility.
So it requires really careful design to make sure the HRA doesn't accidentally disqualify you from contributing to your HSA.
Exactly. You have to navigate the rules carefully to ensure compliance. It's not always straightforward.
Speaking of compliance, these are tax-advantaged accounts. I assume keeping everything above board with the IRS and other regulations is critical.
Absolutely critical. HRAs fall under various regulations, IRS rules, sometimes ERISA, potentially HIPAA privacy rules, depending on administration. Employers must ensure their plan design and operation comply fully.
Like staying within contribution limits for QC areas and EBHers.
Yes, and properly verifying that reimbursements are only for eligible expenses as defined by their plan and IRS Publication 502. They need robust processes for substantiating claims, getting that documentation we talked about. Mistakes can jeopardize the tax-free status for employees and tax deductibility for the employer.
That sounds like a lot of administrative work, especially for a small business owner who's already wearing multiple hats.
Yeah.
Managing all those claims and receipts.
It definitely can be, which is why, realistically, most employers don't try to administer HRAs entirely on their own using spreadsheets. They almost always use a third-party administrator, TPA, or a specialized HRA software platform.
To handle the heavy lifting.
Exactly. The sources mention the importance of online portals provided by these administrators. There are typically employer portals for setting up the plan, managing employee eligibility and allowances, viewing reports on utilization, and handling administrative tasks.
And for employees, the portal is key for getting reimbursed.
Oh, yeah. The employee portal is where you typically go to check your current HRA balance, see your claim history, maybe set up direct deposit details. And crucially, it's usually where you upload pictures or scans of your receipts and documentation to submit a claim electronically.
So much easier than mailing paper forms.
Way easier. Some platforms might even allow you to pay providers directly online through the portal or manage that HRA debit card we discussed. Using these specialized platforms really transforms the administration from a potential nightmare into a much more manageable, streamlined digital process for everyone involved. Platforms like PeopleKeep were mentioned as examples of companies focused specifically on simplifying HRA admin.
Makes sense. Using the right tools seems almost essential to make an HRA work smoothly in practice.
It really does. It handles the compliance checks, the documentation storage, the payment processing, all the things that would be burdensome to do manually.
Okay. We've danced around comparisons to HSAs and FSAs quite a bit. Maybe we could just quickly crystallize those key differences side by side, like a cheat sheet.
Good idea. Let's hit the main comparison points. Funding, ownership portability, requirements, use for premiums, and rollover. For HRA versus HSA versus FSA.
All right, point one, funding. Who puts the money in?
Funding. HRA, employer only. HSA equals employer and/or employee can contribute. FSA. Mostly employee contributions, pre-tax payroll deduction, though employers can contribute too.
Okay. Ownership and portability. Who owns it? Does it travel with you?
Ownership portability. HRA equals employer owns the account allowance. Funds are generally not portable. HSA, employee owns the account. Funds are fully portable. FSA, employer owns the account. Funds are not portable. Generally use it or lose it.
Got it. Requirements. Do you need anything specific to have one?
Requirement. HRA depends on the HRA type, e.g. small employer for QSE HRA, individual coverage for ICHRA, group plan integration for GCHRA. HSA must be enrolled in a qualified high-deductible health plan, HDHP. FSA just needs to be offered by your employer as a benefit. No specific health plan required usually.
Can you use the money to pay health insurance premiums?
Use for premiums. HRA, OKILs. Yes, sometimes. QSHRA and IHRA can reimburse individual market premiums. EBHRA can reimburse accepted benefit premiums like dental vision. GCHRA integrated cannot reimburse group plan premiums. HSA equals generally NO with very limited exceptions like COBRA, unemployment, Medicare premiums in some cases. FSA equals generally NO.
And last one, rollover. Does unused money carry over to the next year?
Rollover. HRA equals, maybe. It's up to the employer's plan design. Can allow full rollover, partial, or none. HSA equals yes. Funds roll over year after year and grow tax deferred. FSA, generally NO, use it or lose it, although employers can offer a short grace period or allow a limited amount, around $500, $600 currently, to roll over.
Perfect. That really lays out the core distinctions clearly, especially that employer-only funding and lack of portability for HRAs compared to the employee ownership and portability of HSA.
Yeah, absolutely. Understanding those fundamentals helps everyone see where each tool fits best. They serve different purposes and have different strengths and weaknesses.
Okay, well, there we have it. A pretty thorough deep dive into health reimbursement arrangements.
Yeah, we've covered a lot of ground. What they are, fundamentally, these employer-funded plans focused on reimbursement, not pre-funded accounts.
We walk through how they work that pay, claim, get reimbursed cycle, plus the options like debit cards that make it easier, and why that reimbursement model is key for employer cost control.
We dug into the why now, the huge drivers like controlling premium hikes, gaining budget predictability, tax advantages, and tailoring benefits for employers.
And for employees, getting that crucial choice, real help with out-of-pocket costs, tax-free reimbursements, and that potential for rollover.
Then we navigated the four main types. QS-EHRA for the small guys without group plans, ICHRA for any size wanting to fund individual coverage, GCHRA integrated with group plans for expenses, and EBHRA for those specific accepted benefits.
Saw how they play out in the real world with those case studies, saving money, boosting performance, solving multi-state issues, even linking to retirement. Really shows the flexibility.
And we covered those important nuances. Checking the plan document for your specific eligible expenses, understanding the non-portability factor, the careful coordination needed if you have other accounts like an HSA, and the absolute necessity of compliance and good administration, usually via online platforms.
It's definitely clear that HRAs offer a really flexible, potentially powerful way for employers to offer health benefits, either instead of or alongside traditional insurance.
They represent a significant shift towards more defined contribution models and health benefits.
So maybe the final thought to leave everyone with is this. We're all grappling with rising healthcare costs, right? And workforces are more diverse than ever. In that context, could these more customizable, employer-funded approaches like HRAs be more than just another benefit option? Could they signal a more fundamental change in how companies think about providing health benefits, moving away from one-size-fits-all towards models that give employers more cost certainty and employees more personalized control? Something to definitely think about for your own situation or your company's strategy going forward.